in conjunction or in correlation with a given change in the market. So if the S&P 500 goes up 1%, what would we expect a company's stock to do? If it goes down 1%, what would we expect a company's stock to do? A beta of 1 means we would expect an exact mimicking of what the market is doing or has done. All right, -1 would be a perfectly negative correlation, so it would move opposite of the market. All right, so this is a measure of risk, beta, a measure of systematic risk. Typically, you'll find betas ranging, I'd say 0.5 to 1.5. Anything below or above that. Here I know the slides say above 2.5, but you don't really see a lot of betas up that high for public companies. The interesting thing about all three of these items is we're not calculating them, we're looking them up. These are items that we can find that are pretty readily available to us if we work in an investment bank, or even if we don't. Again, we can go to the Fed website and get our treasury rate. You can go to a number of different data feeds, whether it's Bloomberg or different sites to get a company beta, usually a 2 or a 5-year beta. That is looking back either 2 or 5 years, measuring daily changes in a stock price, correlating that with daily changes in the market returns. And we typically can look this up, the market risk premium, typically we can look this up from a source called Ibbotson. Ibbotson Associates publishes, I think it's a quarterly, I think it's stocks, bonds, bills, and inflation quarterly. They will give you short, long, medium-term market risk premium data. Pretty easy to find. So when we talk about the drawbacks in the DCF approach, most of those drawbacks are actually specific to CAPM. And more specifically, we're talking about drawbacks as they relate to beta and the market risk premium. These are both items that have been calculated on a historical basis. In case of beta, a lot of times you'll see going back 5 years. So every day for the last 5 years, what has that stock price done relative to the index? Market risk premium, you can calculate that going back as far or as short in duration as you want to. You can go back 80, 90 years, you can go back 10, you can go back 30, you can go back 5 years, and a lot of times those vary quite a bit. Think of the volatility we've experienced in the last year in the markets, in the equity markets. Valuations have been all over the board. In a lot of cases, these market risk premiums, if you go back, say a year, and now the market's had kind of a run up, but if you were sitting back at, say, December of last year, after all of the drop in valuations, and you went back only a year or two, you might actually see a negative market risk premium. So there was a negative premium associated with holding equities as opposed to holding risk-free securities. Right? And these are historical measures. They are not predictors of future returns. Right? Just because a company's beta, and Jeff mentioned the example of GM, might have had a beta of 1 at one point, well, we've seen what's happened since then. So it doesn't necessarily hold for the future that betas are going to be predictors of stock price returns, and market risk premiums can change based on volatilities as well. And they can vary considerably depending on the period you're analyzing. Right? So if you get asked in interviews, what are the drawbacks of DCF? Why isn't DCF used as often as these other methodologies? Those could be 2 good answers to give. Now, specific to Arvis's question, what if we're looking at a private company? Right? Private companies don't have publicly traded equity, so we can't look up their beta. And this is exactly the question we're going to be dealing with when we get into our model. Our company A, our hypothetical company, does not have public equity. We need to figure out what is the beta. What would be a relevant beta to use for that company? So what we do is we actually take a look at our public companies from our comps, Kraft, Conagra, those same companies we've been looking at. We look up their betas, and then we do something called unlevering those betas. Remember, beta relates to stock prices. It's calculated based on movements in stock prices, and as we talked about last week, stock prices, stock equity valuations, equity multiples can be affected by leverage. So to the extent that our 5 companies are using different amounts of leverage, their equity prices are going to be affected in different ways. If we want to remove that effect of leverage, we can do what we call unlevering their betas. And when we do that, it gets us down to something called an unlevered beta, or also known as an asset beta. What would the beta of that company be if it had no leverage. The formula we use, very simple. I mean, it's just basic. It's a basic calculation. If we want to unlever a beta, we take its levered beta, we divide it by 1 plus the debt to equity ratio times 1 minus the tax rate. Debt to equity ratio is basically how much debt relative to equity is that company using in its capital structure. How much leverage is it using? So we're taking into account its leverage when we're unlevering. And then what we do for our subject company is we choose some unlevered beta. Sometimes it's the mean or the median unlevered beta of our comps. And we re-lever it with an assumption of what our subject company's capital structure could or should be. What is its optimal capital structure? What is its optimal mix of debt to equity? All right, and that's where it really gets a little murky in terms of choosing that. Sometimes we'll choose something similar to the industry. Sometimes if we've got access to the company's CFO, they can tell us, well, we're always shooting for a 40-60 split debt to equity, or debt 40%, equity 60%. You might use that. But absent that, and in the case of our made-up company, Company A, we're going to re-lever the beta using an assumption of capital structure that is pretty similar to, I think it's the median of our comps. We'll see that when we get into our WACC analysis. Does everybody understand why we unlever and then re-lever beta? All right, good. So that's the cost of equity. Cost of debt, typically a lot more straightforward. We're not doing a CAPM. Typically what we're doing is looking at each company's actual cost of debt. So we'll do this analysis for Kraft, we'll do it for Conagra, we'll do it for Kellogg, et cetera. We'll go to their debt footnote in the back of their most recent filing, 10K, 10Q. It will generally give us what their interest rates are and what the interest rate is on each respective piece of debt that the company has. And from there, it's really just a matter of calculating a weighted average of their debt. Before we do that, we need to make sure that we're taking into account a couple different categories of debt. Most companies don't have convertibles, but if they do, again, just like we did in our dilution exercise, in our treasury method exercise last week, if it's convertible debt and if it's in the money, we treat it as equity, we no longer treat it as debt. Same thing holds for this analysis. All right, so we're taking each company, what is their overall cost of debt? We'll do this for our subject company as well. All right, maybe the CFO can tell us it's 6%. We've got one line of credit outstanding at 6%. Our work is easy. Otherwise, we might need to estimate what the cost of debt might be by looking at comparable companies in the industry, making some judgment calls. But basically, the analysis is to take a weighted average of each company's individual cost of debt. So if a company has $500 million of 8.25% senior notes, $250 million of 9% notes, $300 million of 12.5% senior subordinated notes, and a tax rate of 40%, we take a weighted average of that, gives us 9.64, multiplied by 1 minus the tax rate to account for that tax shield, give us a weighted average cost of debt of 5.8% in this case.